Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Kevan Flanigan, U.S. Deloitte Private Risk and Financial Advisory Leader, to discuss how private U.S. companies feel about their strategies in what's been a challenging economic environment. It is great to have you with us, Kevan. Welcome to Trade Talks.
Thank you, Jill. Great to be here.
And let's talk about the survey here. How are private company findings so important to what we're seeing in the broader economy?
Yeah, well, first, private companies are the engine of our economy, right? So as they're going and feeling in terms of level of confidence and strategic planning, there are broader macroeconomic implications. And we got some interesting feedback through this survey in terms of, really, I'd put under the overarching theme of liquidity in terms of how they're planning on strengthening their balance sheet, raising capital to achieve their strategic objectives, and doing so in a challenging environment, both from a capital markets and interest rate environment, but also just from a inflationary and margin management perspective.
What was the most interesting thing about the Deloitte Private company survey?
Yeah, so we heard resoundingly, nearly 90% of our respondents said they were planning to raise incremental capital and they were facing increasing challenges to do so. There were a variety of reasons for that. All of them cited, or a vast majority of them cited, the need to fund hiring. That was clearly talent, and hiring was objective number one, but technology was right behind it in terms of objectives. And they cited the need to raise capital in an environment that's gotten more challenging and more costly, again, given interest rate increases and just margin pressure across the business writ large.
Right, and according to the survey, half of private companies are reporting declining valuations. We certainly know what's happened in the private market over the past 18 to 24 months. What does that signify to you that you're seeing half the companies reporting such a drop in valuation?
Yeah, we saw a real bifurcation as well. It's sort of a tale of two cities, in that those who reported a valuation decline also reported, frankly, more of an urgent need for capital, more likely that they were going to tap the bank markets, even though it was going to be expensive and challenging capital to raise, versus the other, call it 50+% that said their valuation was still pretty good. They were facing the need for capital for strategic growth, but far less of an inference of distress or that type of perspective, a more optimistic approach, and more likely to raise equity, frankly, than their counterparts who felt their valuation had declined.
So what are private companies looking to raise when they're accessing capital?
Yeah, we saw a series of bank debt and subordinated debt or similar along that second tier that I'd mentioned, the folks who felt like their valuation was down, maybe the equity story wasn't strong enough. But we saw a lot of people say they were going to go to their existing investors at friendly capital, if you will, for equity. And even if that equity might be a little more expensive today than it would have been a couple of years ago in terms of the relative valuation, it's friendly capital, it's patient capital, and it allows them to continue to execute their business plans without too much disruption.
What are some of the growth challenges that you foresee?
Yeah, it's constant and consistent themes around margin pressure, continuing concerns around inflation. Several cited the continuing risk of recession and what that would mean to their respective businesses. And really, in spite of all of that, the need to continue to invest to grow the business. And so there's sort of this churning of, we know there's some opportunity out there, we want to raise capital to go pursue it, and yet our day-to-day business is challenging given the rising cost environment and worries about the economic headwinds.
Yeah, I mean, Kevan, the old thing was to, grow at all costs, right? And you had to make such an incredible shift, and let's just call it, 12 to 18 months. So how are private companies adjusting their capital investment strategies in response to what's been such a fast environment when it comes to raising rates and the cost of capital?
Yeah, I think we're seeing some capitulation across that environment where it's been long enough now that, hey, no one is assuming their valuation is going to return tomorrow, that interest rates are going to be cheap and plentiful like the capital might have looked a couple of years ago. So I think now it's okay, we're in a slog. We need to figure out how to navigate this new environment, but we're not being Pollyannish about the fact that things are going to turn around very quickly and we're going to be looking at 2021 again anytime soon. So I think it's really forced a lot of prioritization around, okay, which initiatives are critical? Capital is more expensive and scarce, so how are we going to deploy it will be really, really important. And the things that would be nice to have need to get deprioritized.
Right. All right, Kevan, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.